It's a very busy week for central banks with the Fed's meeting minutes due this evening, the European Central Bank's minutes on Thursday, along with the Jackson Hole Symposium in Wyoming. So what clues will we get about the outlooks for monetary policy? Here to help us understand is Mark Ostwald, Global Strategist at ADM ISI. Mark, good to see you. So what's the key event for you then this week?
Well, I think it's the combination. It's the combination of the messages that we get from the Fed and the ECB, above all from the Fed. There is obviously a stark contrast here. The US economy is actually doing well, and the Fed is cutting rates because it fears the external headwinds, in part precipitated by Donald Trump's trade policies. And the impact that it will have on the US economy. And obviously the dollar is the world's most important currency, and if we're in a state where we're actually seeing the global economy slowing down, then there are risks to the US financial system from all the dollars which have been borrowed offshore. So the Fed does need to be aware of that, and it needs to be aware of it much more than perhaps it ever has done before. On the other hand, it finds itself with a US economy which, in broad terms, above all in terms of personal consumption, is in a very good place. There's not a threat from the housing market or anything like that. Housing is actually a marginal contributor to GDP nowadays. So what we really want to know here is the Fed has basically cut because it's taking out insurance. The market is basically pricing in, I wouldn't quite say Armageddon, but it's certainly pricing in a very, very bleak outlook for the global economy. The two things are not exactly in line. The ECB obviously is has basically warmed the plate for a fairly substantial move at its next meeting, though the problem that we have here, and I think this is the really key issue, is there isn't a lot of room for people to do things. I mean, in terms of the ECB, it hasn't even started tightening at any form. All it did is stop its QE program, and now it's already having to think about restarting it, talking about more rate cuts, and you do start to wonder, well, what exactly do you think you're going to achieve? And while the Fed has managed to hike interest rates, it's not exactly to a particularly high level. And it's in room for maneuver in terms of the traditional interest rate side of the equation is actually quite limited. So how do we square all of that out with, if we are in where the market's saying we are in terms of the global economy, then we need something which is bordering on shock and awe. Now, somewhere along the line, there's a mismatch here, and therefore there is a risk that we actually have to start repricing or rethinking monetary policy.
So when we get the FOMC minutes, obviously we're going to get the rationale behind that first rate cut since the financial crisis. I mean, is the risk for markets that this report is slightly more hawkish than many are anticipating?
Yes. I mean, I think the risk here is basically the market will probably take comfort from the little bit in it says, well, we're ready to do more if the economic outlook deteriorates, but it's actually quite good at the moment. And the market's going to say, well, we actually think it's not good. We think you're wrong. So it will probably take quite a lot of comfort from that. But then we actually get into that point where, if the economic data carries on coming in the way it is, particularly the unemployment data, the inflation data are effectively around target, growth is reasonably solid, then the case for making more aggressive cuts, as a lot of Fed speakers, even people like Mr. Bullard, who is definitely very much on the very dovish wing, have argued, then they're probably not going to deliver until we get markets actually selling off, which ironically, this is the sort of situation. If we see markets selling off and a lot of volatility starting to increase and the curve starts to steepen because the market's disappointed what the Fed's done, then we will get the necessary tightening in financial conditions, which will prompt the Fed actually to take more action. But this is the irony, that the market actually forces the situation on the Fed, but it's not actually economic conditions.
So you point to this disconnect between the market's expectations for how many rate cuts we're expecting this year and the signals from the Fed itself. I mean, where do you stand? How many cuts are you expecting?
I think there's probably definitely, on the way the economy is developing at the moment, there's room for another cut. I think there's definitely room for them to say, we will do more if necessary, but it will be very conditional. I probably only see one more. There's one, possibly two. but you'd have to see a sharp deterioration. That really is a contingent on a very sharp deterioration in the US economy, which at the moment doesn't actually look like it's on the cards. So the next thing, obviously, that we have to move on from there in terms of the Jackson Hole side of the equation is this whole talk that we've started seeing launched by some former central bankers, Stanley Fischer, former SMB President Hildebrandt, talking about this whole idea of helicopter money. You know, if Mr. Powell and his colleagues and all the people who are assembled there at the central bank symposium are going to be talking about anything, it is the fact that they don't have much room now to respond to an economic downturn, if there is to be a substantial one, and what else they could do, and the fact that the traditional methods, even the unconventional QE methods, have not really delivered the sort of results in terms of boosting economies, be it the US, be it the Eurozone, indeed, be it Japan. Look at how long Japanese rates have been where they've been.
I mean, helicopter money is a concept that's been talked about for some time in sort of the newspapers and the literature and academia. But, I mean, is there a chance that that could become a real policy tool?
I think it becomes the chance of it becoming a real policy tool rises with all, you know, as long as the evidence mounts that we're actually, what we've done over the past 10 years since the global financial crisis has basically not improved the monetary transmission mechanism. Yes, regulation's definitely been an impairment, but that's not it's not really worked the way they thought it would. What we've actually seen is a lot of financial engineering going, not much trickling through to the real economy. So at what point do you actually have to consider we need to force this through? We need to actually force it into consumers' pockets. And then, of course, we get to the big question. At what point does someone then say, isn't this a debt jubilee?
I see. So, I mean, we've also got the ECB minutes this week. I mean, what's kind of the key question there, do you think?
I think the key question is how much of the kitchen sink are they going to throw at it? And what we had was with the ECB statement was something basically saying we are going to look at tiering, we're going to look at more QE, we're going to look at cutting rates along, you know, basically the whole everything that they might possibly have in their arsenal and more. And yet at the press conference, Mr. Draghi was basically sounding quite sceptical about what could be actually delivered. So what we want to see is how much skepticism there was about the efficacy and how much they are actually going to be saying, and we can do as much as we want if governments don't actually act with us and coordinate with us, because this is the other thing about the Hildebrandt Fischer BlackRock initiative, is they're saying we need much stronger coordination of fiscal and monetary policy, which we're not getting at the moment, above all in places like the Eurozone. So in terms of the ECB, how much emphasis is there on how, you know, if we do all of this, will it actually improve things, or will it be just another salve as if governments don't act? And obviously a lot of that is then contingent on what happens with Germany.
Particularly at a time when so many banks, so many central banks around the world are shifting to this more dovish tilt. It kind of offsets the sort of effectiveness of some of the monetary policy stimulus.
Yes, if you're looking at it from a currency perspective, I'm not a great believer that actually competitive devaluations do much for people. All competitive devaluations do, if you do get a lot of weakness, is increase your import prices. They don't actually increase your export competitiveness in larger economies. In smaller economies, which are more resource-based, yes, definitely. But in terms of larger developed economies, actually they don't make a whole load of difference, because a lot of it is about quality.
Mark, thank you very much. That was Mark Ostwald, Global Strategist at ADM ISI. I'm Victoria Scholar, and thanks for watching IGTV.